we're diving into some exciting news from GraniteShares today, specifically their expansion of the YieldBOOST family. They launched 2 new ETFs, YSPY and TQQY. So what makes these ETFs stand out, in this market?
The big difference is their approach to generating monthly income. Instead of just relying on dividends, they use an option strategy to boost yield. They're also aiming to keep the NAV from getting eroded.
Right, so it's more active management than a typical index fund?
Exactly. This active approach is supposed to boost returns, but it also means a different risk profile than just passively tracking an index.
Okay, let's talk about that risk profile. What are the potential downsides investors should know about?
The main risk is the volatility you get with options trading. Market swings can really impact how well their strategy works.
Let's focus on YSPY, which tracks the S&P 500. Can you explain how this option strategy works?
YSPY aims for monthly income by selling options on leveraged SPY ETFs. They sell out-of-the-money options to try and get premiums while limiting potential losses.
And TQQY, the one that tracks the Nasdaq 100? Similar strategy?
Yeah, TQQY uses a similar option strategy, but is tailored to the Nasdaq 100. The basic idea is the same, but the specific options they choose will depend on the Nasdaq 100's characteristics.
Interesting. Are there any big differences in risk between YSPY and TQQY because of their different underlying industries?
Well, the Nasdaq 100 is more growth-focused, so it tends to be more volatile than the S&P 500. So TQQY might see bigger swings in its NAV and distribution yield.
The announcement also mentioned new leveraged ETFs on Intel, Dell, and Qualcomm. How do those fit into GraniteShares' overall plan?
These leveraged single-stock ETFs give investors focused exposure to individual companies, with returns amplified. They're really for more experienced investors who are comfortable with higher risk.
What should investors think about if they're interested in these leveraged single-stock ETFs?
Well, those amplified returns also mean amplified losses. These are riskier investments, really only good for short-term trading. They're not for long-term buy and hold.
Okay, back to the yield boost strategy. What are the main benefits for investors looking for income?
The main benefit is the potential for higher monthly income than you'd get from traditional dividend ETFs. The option strategy aims for a steady income stream.
How does yield boost compare to other income strategies out there?
It's unique because it combines options selling with leveraged ETFs. This could mean higher premiums than selling options on unleveraged ETFs. But you have to remember the increased risk.
What makes the yield boost strategy successful?
It really depends on accurate market predictions and choosing the right options. How well it does is directly tied to how volatile the underlying indices are and which direction they move.
The info mentioned management fees and expense ratios. How do those compare to similar ETFs?
The expense ratio of 1.07% is competitive in the leveraged ETF world, but investors should always compare the total cost, including brokerage fees, when they're deciding.
Any fee waivers or promotions going on?
Yeah, there's an agreement to waive fees or cover operating expenses to keep the total expense ratio at 1.07% until the end of 2025. That's temporary, though.
The documents mention distribution yields and how often they pay out. Can you clarify what investors should expect?
YSPY aims for monthly distributions, but the actual amount will change based on market conditions and how well the option strategy works. Right now, the distribution yield isn't available.
How reliable are these monthly distributions? Any guarantees?
No guarantees. The distributions depend on how the option strategy performs and market conditions. Investors shouldn't count on a consistent amount.
The performance data is limited. What can we learn from what's there?
The limited data shows we need to be careful. Past performance doesn't predict future results. Investors should really think about the risks.
With so little historical data, how can investors figure out the potential returns?
Investors should read a prospectus carefully and think about their own risk tolerance. They should also talk to a financial advisor to see if these ETFs fit their goals.
Who's the ideal investor for these GraniteShares YieldBOOST ETFs?
These ETFs are best for sophisticated investors who can handle high risk and have a short-term investment plan. They're not for everyone.
What should investors consider before investing?
They need to carefully assess their risk tolerance, investment goals, and how long they plan to invest. They should also understand options trading and leverage.
How do these GraniteShares ETFs compare to similar products?
The main difference is the combination of option strategies and leveraged ETFs. This makes a unique risk-reward profile compared to traditional index funds or other income ETFs. A real comparison needs a detailed look at specific competitors.
What are the main advantages and disadvantages compared to traditional index funds?
The main advantage is the potential for higher income. The main disadvantage is the higher risk from options trading and leverage.
What's your outlook for the future performance of these ETFs?
Predicting the future is always tricky. How well these ETFs do will depend on many things, including market conditions, how well the option strategy works, and investor sentiment.
What factors could impact their future performance?
Market volatility, interest rate changes, and the overall economy will all have a big impact. How well the option strategy works is also key.
So to sum up, GraniteShares YieldBOOST ETFs offer a unique way to generate income, but they're also pretty risky.
Investors should carefully consider the potential rewards against the volatility and complexity before investing. Doing your homework is really important.
And remember, past performance doesn't guarantee future results.
Absolutely. Investors should talk to a financial advisor to see if these ETFs are right for them.
That was a great discussion. Thanks.